All right, this video is for Module 41, and this is starting a new unit on international trade and finance. This is the last unit for macro. Can you feel it? Very excited here. So what we have to start with is that we have to start with something called balance of payment accounts. And balance of payment accounts basically is this kind of summary of all these international transactions for a particular time period. So we're looking at, mostly people think of balance of payment accounts. People usually think of the exports and imports, and it does include that, but balance of payment accounts actually includes a lot more than imports and exports. Yes, we have exports going out of our country and we have imports coming into our country, but we have a lot of other things going on that, for example, we may have foreigners that are specifically buying up, for example, stocks in the United States, or maybe they're buying up land, or maybe we have citizens in our country that is sending money abroad. That's going to be also included in the balance of payment accounts. So there are two major accounts that we need to be concerned with. The first type of balance of payment account is what we'll call the current account, and we're going to abbreviate that CA. And current accounts are going to be specifically for goods and services, so things like exports and imports, but it's also including, we got our goods and services, but it's also including factor income. So factor income is going to be any income that is gained or sent out of the country from factors of production. So for example, if you have let's say a foreign car company that has a factory in the United States and they own the land the factory sits on, that would be factor income. Or, vice versa, if it's an American company and they own land in another country where their factory sits, that would be factor income. And then you also have international transfer payments. So transfer payments is literally money that is being given out and it's going to be sent outside of the country. So think about this. Why would an American citizen, use the United States as an example, why would the American citizen send money abroad? Like, for example, why would an American citizen send money to Mexico? Oftentimes, it's because private citizens are actually sending money to home. They're sending money to relatives. A lot of times you have individuals that maybe the families sent particular individuals into the country to get a good job, and they're expected to send some of their money home to help out their relatives at home. So that's included in the current account. Now, kind of a subcategory of a current account is what we call the balance of payments on goods and services. And this is going to be the difference between the imports and the exports. So this is just focusing on one small piece of the current account. Your book does talk about a couple of other balance of payment accounts, a couple other current accounts. But I'm just mentioning this one particularly because, like I said, exports and imports is something that people usually think of with international transactions, but it is a very small piece. So the major account is current account, and the balance of payments on goods and services is kind of like a subcategory. Another type of account is a financial account. Financial account used to be called a capital account, and the only reason I put that in there is because it's mentioned in your book, but also in the AP course description, when it talked about the financial account, it also mentions in there also called capital account. So I don't know if they'll reference that way or not, but that's what it's called. But the financial account is for financial assets and direct foreign investments. So what this means is that you can have foreigners that are going to be owning, for example, stocks, bonds, real estate. They're going to be owning these investments just like Americans can own, but they're foreigners that are owning it. And then direct foreign investment is when foreigners, for example, will take their money and they will go and invest it in a business in the United States. And so for whatever reason, that maybe the rate of return is a lot better in the United States than it is at home. So that's what else they can do. So two major accounts, the current account and the financial account. Now, Basics of how this actually works. Money coming in is always seen as a credit, and money going out is always seen as a debit. If you are in an accounting class, it's no different than accounting. Anytime, for example, we're talking about money coming into the country. So, for example, if we're talking about imports and exports, which one would be considered a credit, money coming in? Hopefully you said exports. Exports are going to be a credit because we are going to be sending the good or service abroad, but they have to send money back to be able to pay for it. So that's money coming into the country, and that's a credit. Whereas imports are going to be a debit, because imports, we are going to have the good or service coming into our country, and we are going to have to send money out. So that's a debit. So rules of debits and credits, and this is kind of a general graphic. And so it's saying that anytime assets increase, so you're buying an asset, it's a debit. Anytime expenses increase, that's also a debit. Anytime liabilities increases, that means that somebody owes you, that's a credit. Anytime your income increases, that's going to be also a credit. It's money coming in. Anytime you have capital coming in, so capital, for example, financing for businesses, that's also a credit. And then on this side, it's going to be basically the opposite. All of these things are repeated. They're just decreasing rather than increasing. So all transactions, however, cause a credit and a debit. It just depends upon what country you're talking about. So, for example, if I said the United States exports corn to Mexico, okay? For the United States, it's an export. So that means for the United States, it's a credit. However, for Mexico, it's an import. And so for Mexico, it's a debit. So that's what I mean by all transactions cause both credits and debits. It just depends upon which country you're looking at. Now, when you add the current account and the financial account together, you are going to equal 0, because basically what you have happening is that you have, in both the current account and the financial account, you have money going in and you have money going out. And so you can kind of think of it as like a household budget, right? Your parents, have money coming in from their job and maybe any investments they have, but money is going out for any time they pay for expenses. So, maybe they pay for their mortgage and your utility bills and your activities and whatever. Adding those together is going to equal 0. It should be a balance. Now, for the balance of payments, if the current account and the financial account, so CA plus FA, doesn't equal 0, then the central bank in that country will go and buy or sell currency to resolve the imbalance. So, for example, if there is a surplus and you have more, for example, you have more credits than you have on debits, okay, they're going to have to get rid of some of those credits. So they're going to have to buy up some currency to get rid of some of those credits, or vice versa. Okay, so keep in mind that the central bank is there to kind of even out the score if it doesn't even out by itself. So they will take some of their currency and buy and sell. Now, changes in the current account or the financial account all have to be offset by an equal and opposite change in the other. Because remember, they have to be added together, they have to equal 0. So for example, if your current account goes up by, say, $20, I know it's a very small number, but goes up by $20, and so then as a result, the financial account, what has to happen to that? The financial account has to go down by $20, because if you add plus 20 and negative 20 together, then you will get 0. So that it always has to balance itself out. Okay, and then last, all balance of payment transactions do impact foreign currency, the foreign currency market, since you do need foreign currency to be able to buy foreign goods, as vice versa, meaning that you need to sell, in order to sell foreign currency or sell foreign goods, they need to go and they also need to get involved in the currency exchange. So this is going to impact the foreign currency market, and we'll talk more about the foreign currency market in our next video. So just know that, because if you are buying, for example, you're importing goods, if you think about it this way, is that I'm importing goods from another country, I'm going to need to pay for those goods, and they're not going to want US dollars, they're going to want whatever the country is that I'm importing from. So for example, if I'm importing from Japan, for example, I have to pay for those Japanese goods with Japanese yen. Okay. And so that increases the demand for the Japanese yen. But on the flip side, if I am exporting goods, okay, so I'm exporting goods from the United States, they're going to have to get US dollars to be able to pay for those exports. And so that's going to increase the demand for the US dollar. And like I said, we'll talk more about that in our next video. And then lastly, the financial account will also impact the loanable funds market. Because remember, we talked about capital inflows. And capital inflow is basically foreign savings. And so when foreign savings goes up, some of that money is used in investment spending. And so some of that money will increase the investment spending. So capital inflows will increase the supply and capital outflows will decrease the supply. So in this case, for example, this is a graph of the loanable funds market. We have our supply curve shifting to the left. So what do we have happening? We have capital outflows or capital inflows are decreasing. So we have less foreign investment. And so that also impacts the loanable funds market. Capital inflow is motivated by a couple of things. So it's motivated by higher interest rates. So for example, interest rates from country to country are going to vary. So in this example here, we started off at an interest rate of 5%. And maybe this is the United States, and this is 5% interest on the investment. But maybe we have, let's say, England. They have a interest rate of, say, 7%. Okay. If you're an investor, which one do you want to be going with? The United States with an interest rate of 5% or the UK with an interest rate of 7%? Well, duh, 7%, because then I earn more from my investment. So that's going to motivate more people to invest in and move their capital inflow over to the UK rather than the United States. Where capital inflow is also influenced by a growing economy. When investors are looking at and foreigners are looking at different economies in different countries, they will notice that some economies are growing more quickly than others. And so they're going to want to get in where it's growing because obviously they'll have more return on their investment. Sometimes they just want to diversify risk. That's a big thing with investments. You want to try and not put all your eggs in one basket. Remember that? So we're going to invest a little bit in this country and this country, and maybe this one's safer than this one. So you're going to kind of spread it out. And then there's also business strategies involved. And so some businesses just want to simply grow more in a particular country than others. So it all kind of plays together. Okay, hopefully that makes sense. In class, we will play a game where we're going to do an activity to kind of demonstrate the different types of balance of payment accounts. So hopefully that will clear it up. But let me know if you have any questions.